Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Freehold Royalties stock so we can determine if it's a buy or a sell. Freehold Royalties manages one of the largest oil and natural gas royalties in Canada. They also have a significant land base in the US. The company receives royalties from oil producing wells and pays investors a monthly dividend with a portion of its profits. The company is headquartered in Calgary, Alberta, Canada, and was founded in 1996. Let's get started with the model. This is a mid-cap company, 2.2 billion market cap. They're trading at $15 a share, and they have 151 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow doubled from 2021 to 2022. It did drop a little from 2019 to 2020, but it is positive every year. Their expenses are pretty low. Net income is the profit or loss on the income statement. It's revenue minus expenses. That was highest in 2022 at over 200 million, negative in 2020. Revenue is a sales for the company, and that was only 90 million in 2020. Then it more than doubled in 2021. Then it almost doubled into 2022. Let's look at the capital structure. 960 million of equity, 158 million of debt. They're 86% equity, 14% debt. And they have a really high WACC, 14.3%, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 2.2 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $2.1 billion. We divide that by 151 million shares. And we get a calculated stock price of $13.88. They're trading at $14.84, so they're trading at a 7% premium. It's a sell according to the model. Simply Wall Street's valuation is $22. They're saying it's 33% undervalued. 16 analysts priced this stock, and the average price target is $20. They're saying it's 33% undervalued. This is where the stock has been trading since 2004. At its peak, it was close to $30 a share in the beginning of 2014. Then it got really low during COVID. It looks like about $2-3. It has come up quite a bit since that bottom, but it's still trading a lot lower than what it was pre-2016. So there could be a lot of upside with this stock. They pay a monthly dividend, and they've been increasing it. It's up to 9 cents a share. Look at that yield over 7%, which is 50% of their free cash flow, 78% of their net income. So to summarize, I have them trading at a 7% premium. I rank their free cash flows and revenue 7 out of 10. Their ratio is 5 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.